The current pre-market price for Duolingo Inc. on the NASDAQ under the ticker DUOL is $190.11 USD, reflecting a stunning and painful minus 26.89% drop from yesterday's close of $260.02. If you are an investor in Duolingo stock, this morning is a stark reminder of the market's punitive nature, especially toward high-growth companies. The general expectation from investors going into the recent earnings report was that Duolingo, the undisputed king of gamified language learning, would deliver another solid, almost predictably great quarter, given the company's fantastic user growth metrics and successful push into new content like music and math. The reality that has blindsided the market and caused this violent sell-off is not a miss on current performance. In fact, they beat both revenue and adjusted EPS expectations quite handily, but a shortfall in the forward guidance for bookings, which is a leading indicator of future subscription revenue. This is the unexpected angle that forces us to reevaluate the entire thesis. The market is not selling the past quarter, it is selling the next quarter's anticipated growth deceleration, creating a massive curiosity loop about whether the company's strong user growth can be converted into the high-margin revenue growth Wall Street has come to expect and demand. The common ground here is that Duolingo is, by all accounts, a phenomenal product and a category leader. Its daily active user and monthly active user numbers continue to soar, driven by clever gamification and the iconic Green Owl brand presence. We see this success reflected in the reported Q3 revenue of $271.7 million, comfortably ahead of estimates, and an astonishing adjusted EPS beat. The company has essentially proven it can execute on its growth strategy. The belief is that a great product with expanding user engagement must translate into a great stock price. However, the deeper take, the contrarian challenge that explains today's price action, lies in the relationship between user growth and the monetization pipeline, specifically bookings. Bookings represent future revenue tied up in things like multi-year subscriptions, and when the fourth quarter bookings guidance came in softer than the analyst consensus, $329.5 million to $335.5 million versus an expected $343.6 million, it signaled to a hypersensitive market that the rate of converting those millions of engaged free users into paying subscribers or getting existing subscribers to commit to longer or higher-tier plans like Super Duolingo or Duolingo Max might be slowing down more than anticipated. This gap between the fantastic reported execution and the slightly diminished forward expectation is the engine of the current sharp decline, completely dominating the narrative around the stock's recent movement and erasing a significant chunk of value in a single pre-market session. Daily price swings like this are brutal but instructive. This volume of selling activity, pushing the stock down over 26%, suggests a high concentration of institutional investors are hitting the sell button based on that single data point, the soft bookings forecast. When you consider that over 90% of Duolingo stock is owned by hedge funds and other large institutions, as our analysis of recent 13F filings confirms, with massive players having recently adjusted their positions, this kind of coordinated volume creates a vacuum, sucking the price down. The narrative is that these players, having paid a premium for a stock priced for perfection, see the slightest crack in the future growth story and immediately de-risk. This is especially true in the current macroeconomic environment, where higher interest rates make future earnings less valuable today, putting immense pressure on growth-oriented technology stocks to deliver flawless forward guidance. This reaction, despite the strong revenue beat, shows the fragility of the high valuation. The sector momentum is also working against Duolingo this morning. Investors broadly are watching how AI is changing education, leading some to question the long-term competitive moat. While Duolingo is positioning itself as an AI-first platform, as seen with features like Duolingo Max, the fear, however irrational in the face of strong user metrics, is that ubiquitous free generative AI tools might eventually cannibalize the demand for paid structured learning platforms. This market pressure is what creates volatility that firms offering online investment advice or services like Schwab Intelligent Portfolios or Intelligent Portfolio Options are constantly trying to model and manage for their clients. A dramatic one-day movement like this is the moment of truth for many portfolio strategies. Beyond the immediate market panic, let's enter our understanding of what Duolingo Inc. actually is and how it makes its profits. Duolingo operates a freemium business model. The core product, the gamified language lessons, is free and supported by ads. This free offering is critical to its mission of making education universally accessible and is the engine that drives its massive user base, which recently surpassed 50 million daily active users and over 135 million monthly active users. The monetization comes from two primary sources: subscriptions to Duolingo Plus, or the higher-tier Super Duolingo or Max, which remove ads and provide extra features like unlimited hearts or personalized AI feedback, and the Duolingo English Test, DET, a cost-effective, high-stakes language proficiency exam that competes directly with older, more expensive tests. This dual-engine model, built on a foundation of massive scale, is a key reason the stock has historically been viewed so favorably. Unlike companies that rely heavily on paid customer acquisition, Duolingo has a brand that is a cultural phenomenon, achieving viral growth with minimal marketing spend, which results in remarkably high gross margins, a key financial quality that institutions scrutinize. The fact that the company's recent Q3 saw a year-over-year increase in 34% in its paid subscriber count, heading 11.5 million, underscores the effectiveness of this freemium conversion funnel. Past reports showed impressive annualized revenue growth, proving the model is scalable and profitable. This is a contrast to many tech firms, and a reason why Duolingo stock is often looked at with a very different lens than, say, a volatile meme stock on Robinhood, or an early-stage biopharma stock one might trade on an individual brokerage account. The recent quarter's financial pressure point is a slight deviation from the company's previously hyper-accelerated growth path. Despite the revenue beat, we saw a slight deceleration in the year-over-year growth rate for DAUs compared to the long-term trend, and this is what contributed to the nervousness around the forward bookings guidance. For a stock trading at a high multiple of expected sales, any sign of slowing momentum, even a strong growth rate that is simply less strong, is met with severe selling. Management attempted to frame this by saying they are shifting their focus a little bit more towards teaching quality and efficacy, which they believe is the long-term sustainable growth vector over pure near-term monetization. The market, however, is short-sighted and read that as, "We are prioritizing lower monetization growth for a while." This is a classic tension, the company making a long-term product integrity decision versus the market demanding relentless quarter-over-quarter acceleration. Firms like Fidelity Investments, or those offering Fidelity mutual funds or using Fidelity ETFs that hold Duolingo stock in their portfolios, are now forced to weigh this long-term product strength against the immediate drag on price from institutional profit-taking. Looking ahead, the future outlook for Duolingo stock is a high-stakes scenario tied to this expectation versus reality framing. Scenario 1. Reality exceeds expectation. The soft Q4 bookings guidance turns out to be an overly conservative forecast. The shift to prioritizing teaching quality and AI-enhanced features like Duolingo Max leads to a substantial increase in average revenue per user, RPU, and higher long-term subscription retention, which materializes in strong Q1 and Q2 reports next year. The market quickly forgets the Q4 bookings dip and re-rates the stock, sending it well above its prior high, a common trajectory for high-quality growth stocks that experience a short-term guidance scare. This scenario is supported by the fact that the company's DAU growth rate remains remarkably strong, 36% year-over-year, and the company is significantly expanding its content offerings into math, music, and literacy. broadening its total addressable market beyond language learning. Scenario 2. Reality meets or falls short of expectation. The soft Q4 bookings guidance proves to be a true harbinger of a broader trend. Competition, perhaps from highly funded competitors or even new entrants leveraging the latest generative AI in a way that undercuts Duolingo's paid tiers, causes monetization rates to stagnate, despite the continued user growth. The cost of integrating AI to maintain the product edge, which is an ongoing investment they've outlined, potentially compresses margins more than anticipated. The market pressure is what creates volatility that firms offering online investment advice or services like Schwab Intelligent Portfolios or Intelligent Portfolio Options are constantly trying to model and manage for their clients. Better than Share Our Day. This stock action is a perfect illustration of how markets